our last video in November, we covered Horizon Oil's two-element strategy, and also we gave some background on the transformational project that we're implementing in PNG to develop our large gas and condensate resources. The first element of the strategy is to maintain the level of production that we're achieving in China and New Zealand, which we anticipate will throw off an average of 60 to 70 million US dollars per annum in net operating cash flow. The second element of the strategy is to commercialise the 1.5 million tonne per annum LNG project in PNG, which we call Western LNG. And what this represents for the company is a transition from being an oil producer to predominantly a gas producer, but with a significant amount of associated oil. We believe this is the right strategy given the way we see energy markets growing in Asia. Specifically in China, we see about a 40% year-on-year increase in LNG demand. That's the market we're trying to hit with our Western LNG project. We're not receiving value or seeing value in our share price for PNG at the moment. And I understand that. What we've got to do this year is we've got to demonstrate that value. We've got to de-risk the project as we advance our development planning and show investors the tremendous value that the project has. Meanwhile, there is substantial value in our producing fields, given their consistent performance, given the increased interest in the Maari field in New Zealand, and also given the strengthening outlook for oil prices. To give some insight into the financial performance and potential of the producing fields, let me introduce Michael Sheridan, who is our Chief Financial Officer, and in coming months will transition into the role of Chief Executive Officer, while I take on more of a guiding role with a focus on PNG.
Over the last 4 years, Horizon Oil's experienced relatively constant oil sales, approximately 1.3 million barrels per annum. And you can see that in the accompanying charts that were presented at the last year's AGM, the oil sales and our net operating cash flow charts. Those oil sales have led to strong operating cash flow between, or in the range of $50 to $95 million over those 4 years. And that's been in a period of quite low oil prices. As you can also see from the charts, for 2018 we forecast substantial year-on-year uplift, driven largely by the acquisition of the additional 16% interest in the Maari Manaia field and increased oil price. We forecast net operating cash flow for 2018 in the range of $70 to $80 million US dollars, and based on consensus oil price forecast, we'd expect to see an average of net operating cash flow in the range of $60 to $70 million over the next 5 years. Now that cash flow is sourced from our proven, developed and producing oil fields in China and New Zealand, and both of those fields were developed substantially with debt capital. It's this debt which has been the focal point for investors and has clearly had an impact on our share price. But recently there's been growing acknowledgement that the quality of our asset base has enabled material debt reductions, and as you can see in the slide on the screen. Indeed, this time last year our net debt was above $120 million, and we forecast that we anticipated reductions in the order of $20 to $25 million over the year, and that will be borne out in the forthcoming quarterly. As to gearing, with net operating cash flow forecast for 2018 in excess of $70 million and further reductions in debt, our net debt to EBITDAX ratio by mid-year should be below 1.5 times, and that's well below industry averages. Importantly, the surplus cash flow over our debt servicing will fund the company's development planning for the gas condensate resources in Western Province, Papua New Guinea. As Brett has mentioned, the contribution of the company's assets in PNG will progressively increase over coming years and should in time be better reflected in the company's valuation. Shareholders have enjoyed improvement in the Horizon Oil share price over recent months, and to a large extent that's been driven by the increasing interest of institutional funds. And based on their feedback, the reasons for their increased interest is the recognition of the company's revenue being 100% derived from developed producing oil fields, providing direct leverage to a rising oil price. Also, with our all-in free cash flow break-even of $33 a barrel, that's including capital expenditure, there's clearly strong margins when oil is above $68 a barrel. Also, the material reduction of our net debt to levels which are readily sustained by a solid net operating cash flow has been well received, particularly in an environment where our sector peers with good projects ahead of them are looking to raise or have raised material levels of debt to progress their projects. We're also seeing increased recognition of, at the very least, the option value of our material PNG assets. As you can see from the peer comparison chart on the screen, at the bottom row of the table you'll see our ratio of enterprise value to EBITDAX, and at 2.9 times it compares favourably with the industry average of around 7 to 8 times. Each of these factors provides the opportunity for further recognition of value and a significantly higher share market rating, together with the prospects of outperformance as Western LNG progresses.